Without this framework, we probably would have never heard of Warren Buffett, and I would still think that the stock market is basically a casino. Warren Buffett has used the principles of value investing to make billions. But what exactly is value investing? We can broadly define investing as laying out money today in order to receive more money in the future. But what are the fundamentals of this approach that have made Warren Buffett and many other investors so successful? Hey everyone, welcome back to the channel. My name is CJ, and I'm a software engineer and investor based in Chicago. And today I want to talk about value investing. In this video, I'll cover the 3 main tenets of value investing and 5 key areas of value investing that can help us determine our own unique strategy. Please like the video and subscribe to the channel to keep up to date with more investing videos like this in the future. Keep in mind, this is not investing advice, it's for educational purposes only. And there will be timestamps in the video description below if you want to jump around to any other point of this video. Okay, with all that said, let's get started. So what is value investing? In 1934, David Dodd and Benjamin Graham, 2 university professors at Columbia University's Business School, published a book called Security Analysis. This was the seminal text that defined value investing. The text is dense and rather technical, but it lays the ground rules for value investors willing to dig in and do the work. They define an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. 15 years later, Benjamin Graham wrote the book The Intelligent Investor, which Warren Buffett claims is the best book on investing ever written. In this book, Graham explains the principles of security analysis in a less technical and more beginner-friendly way. Additionally, Graham popularized 2 foundational value investing concepts, Mr. Market and margin of safety. I have a couple of videos that explore those concepts more in depth over here. I'll also leave links to those videos in the description below. From the lessons in these books, we can define value investing by understanding the 3 core tenets. Number 1 is that stock prices fluctuate wildly and unpredictably. This is the lesson that we learned from the parable of Mr. Market, Graham's capricious personification of the market. Number 2 is that the underlying business has an intrinsic value regardless of the price or the price movement. The intrinsic value of a company is relatively stable compared to the stock price, and we can make a rough estimate of this intrinsic value using different valuation methods. Here we can clearly see that price and value are not the same thing. The 3rd and final tenet is that we only want to buy a stock when there's a significant gap between the price of the security and the intrinsic value of the underlying business. This is the concept of margin of safety. Basically, an investor will do very well over the long term if they can buy $1 for 50 cents or less. So to recap the 3 core tenets, we need to understand that prices fluctuate wildly, as we can see in the parable of Mr. Market. Businesses have an underlying intrinsic value that isn't necessarily correlated with the stock price, and we only want to purchase these stocks when there's a significant difference between intrinsic value and stock price. Okay, now that we've defined the basic principles of value investing, let's take a look at some of the approaches different value investors can use to define their own strategies. There are many different flavors of value investing principles used by a variety of investors. In the book Value Investing, From Graham to Buffett and Beyond, the authors offer 5 different categories in which investors vary. The first category is idea generation. For idea generation, some investors may use technical, complicated stock screeners, while others, like Warren Buffett and Charlie Munger, will read publicly available information and get ideas from newspapers and other financial publications. Some will even clone other investors in order to get great investing ideas. Mohnish Pabrai is famous for this. The next category is estimating intrinsic value. There are a few commonly used techniques for calculating intrinsic value. One way is to take a quantitative approach and use the balance sheet to lead the majority of your analysis. You could look at the book value or the cash on the balance sheet and use those metrics to determine whether or not there's a gap between the intrinsic value of the business and the stock price. So in this case, you're looking at the assets and the debt of the company, and potentially considering the quality of the business as well. Another approach is the discounted cash flow approach. With this approach, you try to calculate all of the cash that a business will produce in perpetuity, and then you want to discount that sum back to its present value. Next, we want to determine an appropriate margin of safety. Determining an appropriate margin of safety usually depends on the quality of the business. For most investors, a good rule to follow would be the lower quality of the business, the higher margin of safety is required. If you're looking at a cigar butt investment where you're squeezing one last puff of value out of a dying business, you probably want to have a high margin of safety. But if you're investing in a company like Apple or Amazon, the chances are that that business is going to do pretty well, and you may not need such a high margin of safety. Next up, we have position sizing and diversification. Position sizing and diversification is a source of great contention for many investors. I personally think that for an enterprising active investor, portfolio concentration in the realm of 4 to 10 stocks in your portfolio is a no-brainer. The more widely accepted approach advocates for tens or 50 or even hundreds of stocks in your portfolio. And lastly, we have our selling strategy. Selling might be the hardest part of investing. Many value investors like Warren Buffett advertise themselves as buy and hold forever investors. Buffett has even said that his favorite holding period is forever. Holding for a long time helps avoid taxable events, it reduces friction costs, and it potentially helps you capture all of the upside of a business. Other investors may have a strategy where they turn over a portion or all of their portfolios every year, every 6 months, etc. Buffett approaches things slightly differently than other value investors such as Seth Klarman or Bill Ackman. No two investors are alike, yet they've all found great success putting their own spin on the aforementioned categories. It's important to recognize that most successful investors' strategies have evolved over time. For example, and this is slightly simplified, but Buffett's journey has gone from looking at deeply discounted quantitative stocks, commonly known as cigar butt investing, where he would buy stocks that look cheap on a quantitative basis, regardless of the quality of the business. Now he focuses on companies with remarkable fundamentals that will likely compound for a long time, even if the prices aren't at rock bottom. As he says now, he'd rather buy a wonderful business at a good price than buy a good business at a wonderful price. But whether he's investing in a small textiles company or the largest company in the world, the underlying principles have remained the same throughout his career. He's trying to buy an asset based on the microeconomics of a business at a price lower than its intrinsic value, with a margin of safety wide enough to cover him on the downside. In my opinion, analyzing a business from the bottom up is the best way to avoid making an investing mistake. Hopefully by now you understand the principles of value investing. Value investing is an ever-evolving investment philosophy that has helped investors make disciplined and successful investment decisions. If you want to learn even more about value investing, check out my curated playlist of other value investing topics right here. You should also check out The Intelligent Investor and Security Analysis. For a more modern approach to value investing, I'd recommend the book Value Investing: From Graham to Buffett and Beyond. All these books are worth reading cover to cover, and I would highly recommend them. There are links to the books in the video description below if you want to check them out. If you learned something from this video, please like the video and subscribe to the channel, and I'll continue to make more videos like this in the future. Let me know in the comments below if you have any questions or concerns about value investing. I appreciate you watching this all the way to the end. Thank you very much, and I will see you next time.